Today is Monday, June 4th, and this is the ADM Investor Services Monday Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. Today's guests are Alan Bush, ADMIS's Senior Financial Economist, and Mike Niemiec, ADM Investor Services Grain Analyst. Mike, let's start with the grains this morning. What's going on in the grains that might affect trade prices?
Well, it almost seems like we're starting off a new month, being a Monday and after coming off the holiday week, but obviously we started the new month on Friday. But nonetheless, we're on the defensive here early today. Prices are down pretty good in the sense that over the weekend, I think the trade war talk kind of got a little bit more pessimistic. Either being with China, either being with Canada, either being with the EU, either being with the Russians. I just think that and or NAFTA, I just think all those combined have kind of maybe put buying interest at a limit right now. And then we're also looking at other weather aside, the U.S. Right now we got our crop progress condition reports coming out after the close. And as you can say right now, I don't think weather's an adverse. So I think that's the limit of the buying interest here today. The other topics that maybe we're going to talk about real quick here that are going to be upcoming and all, we're going to have a June 12th report coming on out. That's going to be an S&D report that's still going to be looking non-bullish for the old crop. We'll also be weeding ourselves out of the July contracts as we work our way towards the end of the month, that being the first notice date for the July futures. And so we're going to have a lot of money movement going into there. People are going to start turning their interest more into November beans and December corn as opposed to the July contracts. And then at the end of the month, which is going to be another important time period, is we're going to have our our planting acreage and or our quarterly grain stocks coming on out. And so we got a lot of moving parts throughout the whole month that should make the market a little bit interesting this month.
So what specifically is expected in the June 12th USDA report?
So in that June 12th report, two things. Number one, it's going to be old crop in the sense that currently we're running a little bit behind as far as our export pace goes versus what the USA is currently forecasting. So we're still looking at 1 billion bushel wheat carryout. We're still looking at roughly around a 2 billion bushel corn carryout, a 500 million bushel bean carryout. All those are still non-bullish on paper. And then we'll also, for the second time now, get our new crop S&Ds coming on out from the USDA. What will be interesting in that is that with all this trade war talk going on, what does the USDA want to go and do with our exports going forward? Are they going to go and kind of lower them because of the uncertainty? And is that going to add to our carryouts? And we're still looking at the same type of carryouts going next year as we have this year. So once again, a non-bullish environment as far as that goes. And then obviously the big question mark is that a lot of people have roaming targets on is what the yield's going to be. But obviously it being June 4th, we don't know that right yet, but we're going to be watching the weather and crop progress going forward.
Mike, one more question. I know you like to follow the Commitment of Traders report. What did the recent report tell us?
So with all these topics that we've been talking about and the reports coming on up being non-bullish, the Commitment Traders report that came out on Friday still shows that the trade has a net core long position of corn, beans, and meal. They also went long the soft red winter wheat, they're long the Kansas City wheat, and they're a smidgen long the spring wheat. The only thing that they're net short is the soybean oil, and really the oil market hasn't really gotten any traction with the crude oil market expanding here on the upside. So nonetheless, I guess what I'm getting at as far as the Commitment Traders report and the topics that we're talking about, I would think that going through the month of June, the highlight's going to be what's going to go and happen with this money flow if, politics aside, we start seeing a non-bullish USDA report, the crop conditions are okay, and is that money flow that are still, once again, corn net long, corn, beans, and meal want to erode, and maybe part of that was happening here today.
Thank you. Alan, let's look at the financials for a minute. T-bond futures rallied above key resistance areas on Wednesday of last week.
Right.
Is this the beginning of a new bull market for the interest rate futures market?
No, not at all. What happened was we had some political problems in Italy and the European Union, so there was some flight to quality buying coming in, some concerns about the Italian debt risks. So there was a period of flight to quality strength, and in a flight to quality environment, quite often gains of that nature last for only a few days. So no, this is not the beginning of any new bull market in the credit markets, especially at the long end. In fact, I believe that the main trend is still lower as the Fed is likely to raise rates 2 more times this year. Some people saying 3 times. I'm going to have to go with just 2. Also, 2 or 3 more rate hikes next year appear likely. So we are in a bear market in the credit markets, and any rallies of this nature, any type of flight to quality buying should be used as a selling opportunity.
On Friday, it was reported that U.S. non-farm payrolls increased 223,000 in May, which compares to expectations of a gain of 189,000. What is the outlook for the Federal Reserve policy in light of the stronger than estimated employment numbers?
Well, the financial futures markets are indicating that there is still a very strong possibility that the Fed will raise at the June 13th meeting. In fact, the probability is somewhere around 96% of a rate hike then of 25 basis points. So the Fed still appears to be on track to be tightening this year and into next year. Another reason to be bearish on the credit markets.
In addition to the U.S. China trade dispute and the North Korean tensions, we now have the new geopolitical risks associated with the U.S. imposing tariffs on steel and aluminum imports from Canada, Mexico, and the EU. Why did stock indexes rally in spite of this bearish news?
So as Mike mentioned, the trade situation has not gotten any better over the last couple of days. In fact, it may have gotten a little bit worse. So what is the reason for the strength in the indices? In fact, it's higher again today. And I'd have to say that it's still the relatively low global interest rate environment that is still historically low by any standards. So that is the dominant influence that has propelled the indices to new highs this year. And in fact, it's now we're now seeing the Russell at a new record high just today. So it's the interest rate environment that is supportive and is likely to continue to take stock index futures higher. If the Russell is at new record highs, how far behind can the other indices be, such as the S&P, the NASDAQ, and the Dow futures?
Interest rates, the cause for the economic recovery, after 2008, and really the bull market for the last few years.
Exactly. What we're really seeing is interest rates advancing because of the economic recovery. So that comes first and rates follow. So the fact that rates are rising and the Fed is likely to increase interest rates is not a negative overall. It's only when interest rates get too high, and currently we are not anywhere near that point where the Fed has raised rates to a point that is too restrictive. So
Yeah, it's still historically low.
absolutely. And in fact, there are some short-term rates in Europe that are actually still negative at the short end. So we still have the global interest rate environment very supportive, very accommodative, in spite of the Fed raising rates this year and likely to continue to raise.
Thank you both. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.